Hello guys, welcome back. Today, from the third book of FRM, we are going to see about option. Now, that will be in detail. So, let's move ahead. First of all, a brief about what option market is, and then we will move ahead. So, if you see future or forward contracts, you will find that both the parties, means buyer and seller, will have an obligation to fulfill the contract. But when it comes to the option, the word itself says that someone will have an option. So, in option, one party will have option and another party will have obligation. The party which has an option is called long. Party which has an obligation is called short. Now, options are of two types. One are call options, another one are put options. I think we have already seen till this. Okay. Now, long person is also called as holder of the option. The short person is called writer of the option. So, some European countries do use the word holder and writer. Okay. The option is a financial derivative contract which gives the holder a right but not an obligation to buy or sell. So if you want to buy the asset, you do call option. If you want to sell the asset, option to sell. So option is option to buy. And put option is option to sell. Underlying asset at a specific price within a specific time frame. So in all derivative products, specific price and specific time frame is important. Option will have an asymmetric payoff. So we have even seen the payoff diagram, and these are asymmetric. These are not symmetric one, but asymmetric. So your losses can be minimum and your profits can be unlimited. What are the uses? It is used to hedge against price change. It is used in speculative trading. And with the help of that, you can generate additional income also. How you can generate additional income, how it is used for hedging and all that, that we are going to see in chapters which are next to come. Just like call and put options, options can again be classified into American option, European option, Asian, Bermudian, and so on and so forth. Now, what's the difference between American and European option? That we are going to see. Now, the option which can be exercised anytime till the expiry, those are called American option. The options which can be exercised anytime till expiry, those options are called American options. So your option is of 3 months, and after 1.5 months, then you have an option to get it exercised, and those are American options. In European option, options are exercised only at the day of expiry. So the expiry date is 30th September. The option will only get exercised on that day and not in between any day. And that's the only difference between European and American. In American option, you can exercise option anytime. In European option, you can exercise the option only on the date of it. And those are the two different types. Asian option we have already seen, wherein the price, the final price at which we exercise or we calculate the profit is nothing but average price during the exercise period. Means what? We entered at 100 and uh, at the day of expiry, the price is 200. So just take out the average and 150 will be the price of Asian options. So basically, Asian options are price options, wherein American and European, these are based on timings of the options. That's only the difference between American, European, and Asian options. Let's move ahead. Okay, so American options are more flexible but complex to value. Valuation of American option is complex. Now, in last couple of lectures, we have seen valuation of forward and futures. Today, we might try to find out how to value American and European options. Now, typically valued American options are typically valued using binomial trees. So I hope you know binomial trees. These are basically probability trees which are used for valuation. We have a complete chapter on that, so we will see that in the chapters coming. But basically, probability of up move and probability of down move, we need to calculate. So if the option price is 100 today, what will happen after one period? What will happen after two period? And what will happen after three period? That also we can calculate. So this is one, this is second period, and this is third period. And you can extend it to 10, 15 period also. By increasing the number of periods, you are just trying to increase the accuracy of the option price. Now, this up move and down move will remain same throughout. And option price or option value is based on certain factors like volatility, time to expiry, interest rate, and all other things. And its impact on option price is given by Greeks. We have a complete chapter based on Greeks. So we have 5 Greeks to study. And we will see how each one of them impact our option prices. And that is Greeks. Greeks are taken out from Black-Scholes model. What is Black-Scholes model? Black-Scholes and Melton, I suppose. These are the 3 US professors who wrote Black-Scholes model somewhere in 1974. People understood its importance somewhere in 1994, and they got Nobel Prize in 1994 for the same. So till I think in till 1994, this Black died also. So Scholes and Melton got Nobel Prize for their great formula of Black-Scholes option pricing model. And very few people who are in quant finance works on Black-Scholes model. And even after 50 years, Black-Scholes model is widely used. Yeah, European options are easy to value using Black-Scholes Milton model. Yes. Always remember, American options should be worth more or same than identical European option because they have an extra flexibility that you can get out of the option or you can exercise option during any time during the time period given. So American option must be worth same or at least more. If not, then there is an arbitrage opportunity available. Yes, moneyness. Okay. Now, always remember moneyness of the option will always be looked from long position and not from short position. Now, when do you call in the money? When the long position is in profit. So if the long position is in profit, you call it as in the money. When long position is at break even, you call it as at the money. And when long position is not making anything, then you call it as out of the money. So always remember in the money means long position is in profit. So it can be long call or long put. In the money means you are in the profit. Long position is in profit, then we call it as in the money. If long position is at break even, it is called at the money. And if long position is not in profit, then you call it as out of the money. Payoff function is nothing but profit without considering premium or option cost. Okay. What does that means? Payoff is nothing but profit which you generate from the option trading, but without considering the option cost or premium cost. Okay. So let's assume this is P&L on y-axis and this is x-axis. For long call, this is the graph where this x is called strike price or exercise price. ST is today's market price. So ST can be here also, can be there also. And this is the payoff diagram for long call option. Now, guys, please understand here one thing. For long call, if your ST is greater than X, that is today's price is greater than X, then you are in the money. If ST is equal to X, then you are at the money. If XT is less than X, then you are out of money. So, if you are on this line, then you are at the money. If you are on the left of this line, then you are out of money. If you are on the right hand side, then you are in the money. Now, please understand this is for long call. So, if the long position is in profit, then you are in the money. That's only the thing which needs to be remembered. Profit and loss calculations. The difference between payoff And profit and loss is that profit and loss considers the premium paid, and payoff does not consider premium. So premium are not considered in payoff, but in profit and loss calculations, premium are considered. Now, let us look at this example. Now, let's say this is 100 and this is 200. In next 3 months, this is long call. In next 3 months, this price might go up to 1,000, 10,000, 1 lakh. You don't know. So, for long call, maximum profit can be unlimited, infinite. This is a symbol of infinite. But maximum loss will be equal to the premium which you have paid. So max loss is equal to premium paid. Okay. Now, please understand this is for long call. Does that mean that it will be the same thing for short call? No. Let us look at example of short call. If you look at the diagram of short call, it will be like this. Now, the maximum profit for a short call is equal to the premium received, and the maximum loss can be unlimited because this can go down. So, just by looking at the diagram and the name, you should be able to understand how much is the maximum profit and how much is the maximum loss for call as well as put options. Now, if you look at put option, this is a diagram 0. Yeah, this is a diagram for long put. If you see, the maximum profit of long put is not infinite, but it's equal to x minus st, where x is my exercise price and st is current market price. St is current market price. So if st is 0, the maximum profit in long put will be equal to x. Similarly, if you look at the short put, maximum profits is equal to premium received and maximum loss is equal to minus of x. And that's how you need to find out loss and profit. I'm speaking about maximum boundary conditions of both call and put options. Always remember, it's a zero sum. That means if long is in profit, short will always be in loss by exactly equal amount because it's a zero sum. So if long is earning money, short is losing money. If short is earning money, long is losing. Okay. You need to work on certain symbols, or you should keep certain symbols in mind because these are universal. X is the strike price or exercise price at which we have entered into a contract. So, if we take an example of wheat, we have already entered into a contract of wheat wherein I will sell 1 kg of wheat for 30 rupees per kg, no matter what's the market price after 3 months. So, this 30 rupees per kg is called strike price, or also called as exercise price. ST is spot price. What is spot price? The price of that commodity or of that asset at that particular time when we are trying to find out. So today's price basically. Capital C is call option value or basically premium value. Call premium. Now you even have small t and capital C. Small c and capital C. Small c is for European. So if you have European call option, if you want to calculate European call option value, then you use small ct. If you want to value American call option, you use capital CT. Similarly, if you use small pt, that is for European put option value. And if you use capital PT, then that is for American. So valuation also we use small letters for European and capital letters for American option valuation. PT is put value or put option value at time t. Small t is a time subscript. So my option is for 3 months and I have already covered 1 month. So 2 months are remaining. Then small t will be 2 months and capital T will be 3 months. Now these are 5 major things which you should remember because we are going to use them daily. So let's move ahead. Okay, let us look at call option. Call option grants owner the right but not obligation to buy an underlying stock at a predefined price. We are looking from a stock point. So basically, there is a buyer and there is a seller. Now, in call option, buyer has a right. In order to purchase that right, he needs to pay premium. To whom? To seller. That after T number of days, the buyer will have an option either to purchase it from the seller at predefined price, which is also called as exercise price, or to purchase in the market. So X is 30 and the market price is, let's say, 70, then it is prudent for him to purchase at 30 and not go in the market and buy it at 70. So always remember, call option is an option to buy. So generally buyers of the commodity purchase that option. Now, there is an option buyer and option seller. Who is option buyer? He is basically an holder of long position. Option seller is a holder of short position. That's only the difference between option buyer and option seller. Option buyer is also called as option holder. Please remember that. And option seller is called option writer. What are the key components for valuation of option? First is the underlying stock, what we are valuing. Does it give dividends? Does it give interest? If yes, the valuation changes. So which assets are you trying to track or to trade? That is your underlying stock. Then you have exercise price, strike price, which is nothing but predefined price. Exercise price is a predefined price. Then you have maturity. After 3 months, 4 months, 5 months, how much time is remaining to the expiry of option, and that is called maturity of the option. Payoff is nothing but profits. We have already seen profits without considering premium. When will buyer be, or when the option will be beneficial for a buyer? I'm speaking from call option point of view. So always remember, when can it be beneficial for a call option? For a long call option, it is always beneficial when your spot price is greater than the exercise price. So when ST is greater than X, then only you will be in profit. Otherwise, you will not be. Any questions till now? I'm not sure if there is anyone. No issues. Let's move on. Now, always remember, this is from long call point of view. If you look at from a put point of view, this is exercise and this is your ST, and then you will be in profit. So for put option, the profit will be exactly opposite of it. In call option, your profit is calculated as ST minus X. But ST can sometimes be less than of X, less than that of X. I will just say max of 0 comma ST minus X. And this is nothing but payoff of call option. Similarly, if you want to see the payoff of put option, ST should be lower than X, and therefore X minus ST comma 0 and max of. This is the payoff formula for calculating of put option value. And this is payoff formula for calculating the value of call option.
Sir, when it is applicable, at the put option is always if x minus st, that is today's price, st is the today
Exercise price
and
minus.
exercise price.
So
Today's
when
price.
exercise
So
price is
today's
greater
price
than
is
today's
less
price,
than exercise
then
price.
you will be in profit. Yeah, whenever
So
today's
put
price is
option
less than exercise
loss.
price, you will be. Sorry?
Put option, it means I am in a loss position rather than in call option, long call, I am in a profit position.
No. So if you feel that market will go up, you purchased call option. If you feel that market is going down, you purchase put option. So basically, if market goes down, then in put option you can make money. If market goes up, then in call option you can make money.
Okay.
You got my point?
Yes, yes, yes.
Now, it's not profit and loss. It's about market going up and market going down. These things we will look from buyer point of view. That is long call and long put point of view. Let us look from seller point of view. This is short call. This is short put. Now, if you look from a seller point of view, and let me just redo it because we will not be taking premium into consideration. So this is, yeah, this is short call. This is short put. Okay. If you look here, seller of call and put option has unlimited, sorry, seller of call option has an unlimited loss, and profit is just equal to the premium which they might get. Similarly, seller of put option has a loss which is much greater than what the premium they are getting. So when look from a seller of call or put option, then their maximum profit is equal to the premium which they have received. And their maximum loss in case of call, it is unlimited. And in case of put option, till the value gets zero. So their gain will always be limited, is equal to the premium received, and their loss is potentially large loss. And still, most of the people make money by selling options itself over at least a short period. Let us move ahead. Again, I think I have already told you about moneyness. Now, these formula of moneyness are from call option point of view. Now, if you see the definition, in the money means when you are in profit. You means long position. At the money means no profit, no loss. Out of money means when you have when you are uh, in the position where you're losing premium. So the value from here to here, this is out of money. Here to here, this is in the money. Out the money, sorry. Out of the money. OTM, ITM, and this is at the money. Now, please understand that this point you have exercise point, which is also called as strike price. Now, your spot price or today's price, if it is greater than your exercise price in call option, then you are in the money. Therefore, strike price is greater than exercise price. That is, you are in the money, which is also called as ITM. When your strike price, when your strike price is equal to today's price, then you are at the money. And when today's price is less than the exercise price, that is this reason, if today's price is this, then you are out the money. Now, this is from call option point of view. Then you are in the money. If the long position is in profit, not you. If the long position is in profit, then you are in the money. If the long position is not in profit, then you are out of the money. Now, in out of the money or at the money, payoff is zero. You are not going to get anything. But if you are in the money, then payoff is equal to how much money you are going to get. This exercise is 100 and today's value is 200. So your profit will be 200 minus 100, that is equal to 100, and that is called your payoff without considering premium. No premium considered. That is payoff. Okay. I will just draw the payoff diagram of all four here itself. I want you to remember all those four diagrams. These points all are exercise points. And this line is basically your price line, S line. This is long call. This is short call. This is long put. This is short put. Now, always remember, long call and short call, they are mirror images of each other. So if the payoff of long call is ST minus X, the payoff of short call will be minus of in bracket ST minus X. Similarly, the payoff of long put is X minus ST, then the payoff of short put will be minus of X minus ST. I hope you know what X is and what ST is now, where X is an exercise price and ST is current market price. So these are the four payoff diagrams. And you must understand how this diagram came. That is important. Intrinsic value. The true worth of the option is called intrinsic value. Paying the premium. So, how much will be the premium of the option? That is basically the intrinsic value. And the premium for long call option should be equal to ST minus X. Now, let us understand this in a better way. My mistake. Let me just uh, rephrase this slide. Okay. Premiums, which is nothing but option price comprises of two terms. One is its intrinsic value, and another one is time. So, any option price is dependent on two things. One is intrinsic value and another one is time value. Okay. Now, let's take an example. You have option 1 and option 2. You have entered into an option to buy, therefore I am writing call option. To buy 1 kg of wheat from the farmer at 30 rupees. But when you are entering into the contract, the wheat prices are 50 rupees per kg. Okay. Now, will the farmer make such contract with you that even if the market price is 50, he is willing to sell it to you for 30? The chances are no. If he is a rational farmer, he might say, why 30? Give me at least 50. So, if current market price is 50 and you want to enter into a contract at 30, you must give at least 50 minus 30, 20 rupees as premium. Otherwise, farmer will be at loss. Now, this 20 rupees, which is equal to the difference between current market price and your exercise price, that is called intrinsic value. That is fundamental value of option. But sometimes what happens? Today's market price and then 20 minus 30, your value goes to negative. But we won't exercise at 30. We will directly go in the market and purchase it at 20. Therefore, if we don't exercise, our value will be 0. Therefore, if we want to calculate intrinsic value, our answer should be, again, this we are doing it for call option. Always remember, our option should be ST minus X. But if ST is in if ST is less than X, then the value should come at 0. I will give comma 0 and I am taking max of it. And this is the formula for intrinsic value of option, which is nothing but max of 0 comma ST minus X. This is intrinsic value for long call option. Now, again, there is another option wherein you are entering it at 30, today's market price is 50, but this first option was of 1 month and this second option was of 1 year. Now, from a seller point of view, which is more risky? Option 1 is more risky or option 2 is more risky? Because in option 2, the time period is more, option 2 is more risky. So the seller might want more premium. He will not just be ready at 20, he might ask for 30. But the difference between today's market, today's price ST and X is just 20. So if the seller is asking 30 rupees as premium, out of which 20 rupees is intrinsic value, then the remaining 10 rupees will be the time value out of it. Any question here? Perfect. Okay. So always remember, while calculating option price, you have two things. One is intrinsic value, which is nothing but fundamental value, which can be calculated in call option as 0 of ST minus X max of. By this function, you can calculate intrinsic value and you need to add time value to it. Because some options have higher time. So higher time means higher time value. If they have low time, then that will have lower time value. Okay. Payoff graphs. So basically, on y-axis you have profits, on x-axis you have price. This is long call. And this is, we have already seen all the payoff diagrams. But basically, it tells you the relation today's market price and exercise price. And if today's market price is greater than exercise price, you are in profit if you are a long call, or you are in loss if you are in short call. So depending upon whether you are in long call position, short call position, you need to calculate a payoff graph. And that should be on the tip of your fingers. You should be able to recognize what is long call, what is short call, what is long put and short put. Because that will help you a lot. Okay, let us try to calculate a payoff of a call option. An investor writes a at the money call option. So writes means sell. With exercise price of 50, X is given as 50. The stock price rises to 60, ST is given as 60. What will be the payoff to a owner and seller of the call option? So basically, long and short call is asking for payoff. If he is asking for payoff, we will not consider the premium. So payoff for long call option is nothing but max of 0 comma 60 minus 50, and your answer comes out to be 10. For short call, it's just minus of all. That's it. 60 minus 50, that is minus 10. So payoff for long call is plus 10. Payoff for short call is minus. That's it. 10 gain.
Here,
Yeah.
so we'll consider the minus maximum
Uh,
same as a S minus X for
yeah,
short call.
because this is call option. This is call option. So if we see, the formula for call option will be max of 0 comma s minus x. This is formula for call option. If you
Call
see the
option
formula for put option, max of 0 comma x minus s.
minus ST.
Yeah, this is for put option. So basically what we are trying to do, if you cannot remember this formula, that's okay. The idea is just to check this diagram. They are saying exercise price is 50 and today's price is 60. Can you tell me whether we are in profit or loss?
We are profit in 10.
We are in profit by 10. Now this is the diagram for long call.
Long
So long call is 10 rupees. That is the payoff because we are not considering the premium. Let us draw a diagram for short call. This is 50. This is 60. Can you tell me by how much he short call is in loss?
10.
10. So loss of 10. That's it. So if you do not remember this form, draw a diagram. Any questions there?
No, okay.
Perfect. Let's move on then. Yeah. Introduction of to payoff and profit in call option. So always remember, payoff doesn't consider premiums. Profit considers premium. Profit calculation incorporates the premium payoff diagram to visualize the concept. Okay, that's easy. Okay. They want to understand this formula into depth. This CT is nothing but call option price. Call option price, which we will even call it as premium. Height is max of 0 and ST minus X. Now, this is easy. This is X. What if ST is here today? So XT is here. So basically, your payoff will be 0 because ST is less than X. X is 100, ST is 80. If you do not use this formula and just use ST minus X, then 80 minus 100, you will be in minus 20. But you are in long position. You don't go in minus if X is less than ST. So what you do, if the value is in negative, just take 0. And therefore, we are using the function max. Max of 0, comma st minus x. So if st minus x is negative, take the value 0. If xt minus x is positive, take that value. And therefore, we use the function max. Because we do not want it to go down. We want it to come and get fixed at 0. So, when st is greater than x, you are in the money. When st is equal to x, you are at the money. And when st is less than x, you are out of money. This we are talking from call option point of view and not put option point of view. Now, why these mathematical expressions are needed? Because these are used to uh, trade or to code for algo trading. From offshore seller point of view, always remember payoff is in minus. So we have seen when we did short call, we just wrote minus of max of 0, comma st. Why this minus? Because long call and short call, they are mirror images of each other. So when long call is in profit, short call must be in loss. And when nothing is given, payoff is always calculated from buyer's perspective, unless specified otherwise. So if they ask us to calculate payoff of call option, always calculate it from long call perspective and not short call perspective. So just remember minus sign is crucial here. That's it. Now, when you have American call option, then you can exercise it anytime. So you have an added advantage. If you have added advantage, your premium must be greater than the premium of European options or equal to. So always remember, because American call option has an added advantage that they can exercise their option anytime, their premium will always be higher than the premium of European call option. And that this was a question which was asked to us. So always remember, the premium of American call options will be higher or equal to the premium of European options because American option has an added advantage that they can exercise it anytime. Now, the premium of the options are upfront cost. Means they're the cost which are incurred while purchasing option itself. But the benefit to a long party gets at the time of expiry. If you look from a time value point of view, we are incurring C0 here, that is, we are paying premium here and we are receiving money after 3 months, 5 months, or whatever is the period of the option. So, time value should be considered. Its value on today's date should be considered. And that's what exactly happens while calculating the option premium in both binomial also and Black-Scholes also. Lectures. Now, how to trade in options? Now, many a times it's happen that you purchase an option at 30 and it has 3 months to expiry. After 1 month, that is 2 months to expiry, the option price increases from 30 to, let's say, 70. You feel you have achieved your target. So you have purchased the option at 30. You can just take an opposite position and sell it at 70, making a profit of 40 per lot. And that's the profit formula of calculating option. C0 is option premium while entering into the contract, and CT is current option premium. So difference between current option premium and the option premium at the time of buying is your profit from long point of view. And how does premium increases? If you keep on going into profit, the premium increases. So more the profit, more is the premium, because the intrinsic value increases. And then you have purchased option at 30, you are selling option at 70 and making a cool profit of 40 before expiry also, even in European options. So when you sell, there is somebody else who will be buying at 70, and the first contract will keep on going between you and the new buyer. Sorry, between the old seller and the new buyer. Because you were in buying position, you took contrary selling position, so new buyer came. So the contract will keep on going, just the buyer had changed. And that's how you can exit even European option just before the expiry or many days before the expiry by taking counter position. So you were in buy, you took contrary sell position in the same option chain and you get out of it. That's how you can earn profits in options. Now, these are not payoff diagram. Why? Because you are considering their profit diagrams. So this is a diagram for long call, considering premium. This is a diagram for long call without considering the premium. This is a diagram for long short without considering premium. This is a diagram for short call with considering premium. So when you consider premium, you do not call them as payoff diagram, but you call it as profit diagram. That's it. Again, these are all call options. Put options are exactly opposite to this, so I'm not considering them. Let's look from this diagram. I will just draw it here. This is your exercise price. This much is the C. This is C. And ST can be anywhere. So ST can be here, ST can be here, ST can be here, anywhere. Now, if ST is greater than expiry plus the call option premium, then you are in profit. If ST is here, that is less than exercise price plus CO, that is from this point. If it is less than that, then your profit is negative. And if ST is exactly equal to X plus C, then you are at break even. That is no profit, no loss. So always remember, from if you are looking from profit, then you must add and check for premiums. But if you are just looking for payoffs, then no need to add the premium. Any question here? Let's move it. Till now, we have all seen was of call option. Let us try to explore put options. This is long put. Exact mirror image of it is short put. This is the premium. This is also the premium. This is exercise price. This small is C. Okay, let's see. A put option gives the owner the right to sell a stock at a specific price. So, if I purchased a put option, I will have a right to sell it at 60. That is your exercise price. So, if in the market the price is 30, still you can sell it at 60. If in the market price is 20, still you can sell it at 60. If in the market the price is 90, you forget this contract, you can directly go and sell it in the market because you have an option. And that is nothing but put option. So always remember, in put option, when the prices are going down, then you make profit. And in call option, when prices are going up, then you make profit. Always remember, on x-axis you have price. So for put option to become advantageous, the buyer when underlying stock price is less than X. So this is your X exercise price. And when your stock price is less than X, then only you go in profit. Same thing. I'm not going to spend much time on this. Always remember X comes first and then S, input option. So max of 0 comma X minus S, wherein in call option, if you remember, max of 0 ST minus X. And that's the only difference between put option and call option, because in put option, if ST is less than X, then only you are in profit. And therefore, max of 0 comma X minus ST, this is the formula for put option. Intrinsic value of put option. Let's take an example. Strike price is 50 and today's spot price is 30. Can you calculate the intrinsic value of put option? So intrinsic value is equal to max of 0 comma X minus ST, which is equal to max of 0. Just put the things 50 minus 30 and the answer comes out to be 20. And that's how you can calculate intrinsic value. Any question here? Perfect. No questions. These are payout diagrams. This is long put. This is a payout diagram for short put. Now, I would request all of you to draw two separate diagrams so that you can understand it. This is long put. This is short put. And this is your exercise price. If you consider premium, then this is premium. So this is exercise price plus this much is the premium of put, and after that you will be in profit. Now this is for long put. So if you look at the formula again, let's see, we want to calculate payoff. So there will be no premium. So the formula will come like this, wherein this is exercise price and this is strike price. So you will only be in profit or in the money. This is in the money region. You'll only be in the money when your ST, that is today's price, is less than the exercise price. And therefore, XT minus S, this is basically the payoff. And if S is greater than XT, the value comes out to be negative, and therefore I'm putting max of 0 comma S minus XT. So that if there is a zero value, a negative value, you take 0. That's we have already seen. Okay. Call and put option and their payoff. are done. I would request you to keep these things in mind or use the payoff diagram to actually calculate this if you cannot keep this in mind. Just like I do. I do not keep this in mind. I just use payoff diagram and I know the answer. I would also request you to almost by heart all these four payoff diagrams because next weekend we are going to see hedging techniques using option. And then in that hedging technique, we will be working with butterfly spreads. We will be working with straddles, triangle. We will be using two calls, one put, two puts, two call, and all permutation combinations of. And when we do that, you not to understand this because if you do not understand these four payoff diagrams, you will not be understanding how straddle works or how triangle works. And that is the basis of FRM. So I'm going pretty slow. One of the reason of going slow is this, that you should be able to understand all these things. Anyway, let's move it. So options can be exchange traded or over the counter. Now, when they are exchange traded, they can be on individual stocks, they can be on indices, and they can be on exchange traded funds also. Not only that, they can be on currency, they can be on commodity, on exchange traded itself. But we will be looking only from these three parts. Okay. Stock options, options on stocks. They are typically exchange traded and they are American style. Their lot size is 100 shares generally. That is not the case in India, but in US, yes, their lot size is 100 shares per fund. So, if the call price is 3.6, you just multiply it by 100 and the contract will cost you $360 because the lot size is 100. Now, in between, if the stock split, then your options get adjusted, but it does not take into consideration cash dividend, that is, they are neglected. Few of the key exchanges, the major is Chicago Board of Option Exchange, Chicago Board Option Exchange, CBOE, very well known. And they can trade on any options, electricity, marines, uh, what you say, cow, animals, timber, they trade on anything. Then you have Boston, then New York Stock Exchange, Euronet, and then you have International Security Exchange. And these are basically the most liquid ones for stock options. Okay. Now let us see how stock split and cash dividend impacts the option prices. Now, I already told cash dividend does not impact the options. So no adjustments are made for this. So if you want to make cash dividends relevant, you need to make change in your own model. And no exchange change the specification of option for cash dividend. But that is not the case with stock split. So if my one stock got split into two, so first I had only one stock, now I'm going to get two stocks for the same. Then what will happen? The share price will reduce to half, and my exercise price will also get reduced to half. So if stock splits, that for every one stock you will be getting two, then what will happen? Your exercise price will split by half. Now, this is done. Okay. Let's see this example. Assume that you own a call option on the index, that is Nifty for India, with exercise price equal to 950. So X is given as 950. The multiplier of this contract is 100. Lot size is given as 100. Compute the payoff of this option assuming that index is at 956 at expiry. ST is given as 956. This is a call option. So call option is nothing but max of 0, comma ST minus X. So max of 0, comma ST is 956 minus 950. That is 6 multiplied by lot size of 100. And you get a payoff. Payoff of 600 rupees. Any question here? Perfect. Let's move ahead. If there are no questions, just give me a sec. I need to put this on charge. Option specification in trading. Yes. Now, options on Chicago Board of Options Exchange. Okay. What is it? Let me just see. Chicago Board Option Exchange. No, that's correct. Chicago Board Option Exchange. No off. Okay. Now, in Chicago Board Option Exchange, you have three maturity cycles. That is January cycle, Feb cycle, and March cycle. January cycle has 4 months, Jan, April, July, October. February cycle has 3 months, 4 months, Feb, May, August, and November. March cycle will have March, June, September, and December. Now, January, if option starts in January, then it will expire on the third Friday of expiration month. That's compulsory on every third Friday, whatsoever it will be. So, if third Friday is on 20th, then the option will expire on 20th. So on any particular day, you will at least have three expiries. So if you are in January, you will have January, Feb, and March series going on. When January will get over, the next series from January cycle, April will start. When Feb gets over, next series from Feb, May will start. And that's how, on any particular day, you will have at least three series. Okay. I think I already told you this. Yeah. Expiries on weekdays also. So you will have weekly expiry. So every Friday you will have weekly expiry, except the third Friday, because on third Friday you will have monthly expiry. And so people can trade every day in options on weekly expiry. These are leaves. Leaves are for long-term period, and they expire from 1 to 3 years. And they always expire on third Friday of January. This we are looking from index options from Chicago Board of Option Exchange. Chicago Board Option Exchange. In India, we started Thursday expiry. And then for Bank Nifty, we have another expiry. And then for IT Nifty, we have another expiry. So now we have expiry on every day for different indices so that people can trade. Now, if Nifty is at 19,000, what all call option strike price should be there? X. So we can have 18,950, 18,900, 19,050. That's the gap of 50 rupees or 50 in index. Why can't we have a gap of 25? We can have a gap of 25. So this gapping of strike price is decided by exchange. So for low value stocks, the increment in expiry or the increment in exercise price is by $2.5. We are speaking about Chicago Board. For mid-range stocks, increment is $5, and for high value stocks greater than 200, increment is $10. That's how you use the prices. Okay. How do strike price or exercise price evolve? Initially, offer three closest strike price are usually listed. As the stock price moves, more strike price are added. All options are of same types. That is, all options of the puts are called as a class put class. All options of call are called call class. Option with given expiry and a strike price are called series, option series. So if you know option with given expiries and the strike price, then they are called option series. Again, theory. These are non-standard option products. Flex option, Asian option, and cliche option. We are going to see it in detail in their own chapters. I'm not going to speak here. No, no. Okay. Yes. I already told you options and cash dividends. If there are cash dividends, investor need to manually update their valuation model and include dividends. Exchanges will not play any part in options dividends or in cash dividends. So you have stocks called, let's say, Infi, and on Infosys, you got 20 rupees as dividend. Now, please understand options are just contracts. So if you're long option, you are not getting this dividend. If you're short option, you are not getting this dividends. So you will not be getting, but then the spot price will reduce because of the dividends. You need to suffer for. And therefore, you need to manually update your valuation model. But that is only for cash dividend. When it is stock split, then always remember the strike price become half. So if it is 2/1, then strike price is half and number of underlying shares is doubled. But if it is not 2/1, if it is B by A, anything, then the strike price becomes A by B of the previous value and the number of shares increases by B by A basically. So this is the generalized terms. But if it is a cash dividend, there will no change to the options. But if it is a stock split, then what will happen? The strike price will reduce and the number of shares will increase, basically. What if it is a stock dividend? Yes, it will also impact as same as stock split. So a 25% stock dividend is treated as 4 of 5 stock split, and then by B by A and A by B, strike price will change and the number of shares will change. Just a second. Yes. Options are quoted relative to underlying stock. You multiply the quote by 100. It's not always true from India's point of view. Multiply it by the lot size. Because that's how much you need to pay. The strike price, which is also called as exercise price, expiration month, volume, and option class are included. So, all these things you must know before you trade in option. Market makers and floor brokers. Market makers are the people who bring liquidity to the market. Code of bid and ask prices add liquidity to the market. Floor brokers are the people who represents the firms and execute the trades. So angel broking, zero da, these are basically floor brokers. Now, order book officials are the people who put the orders from the floor brokers. Now they are redundant. Offsetting trade. I told you, I was in buy position and there was some person in the sell position, and the option is for 3 months. Now I want to get out of it, but you're stuck for 3 months. So if you want to get out of it, the best way is to take offsetting position. So if you're in buy position, in the same, and somebody will be in the buy position of the same contract. So what will happen? Your buy and your sell position will cancel out each other, and this seller and this buyer, they will be a counterparty to each other, and you will get out. And that is called offsetting trade. Now, remember one thing. When I offset the trade, my open interest will not increase or decrease. Just a new buyer came in place of old buyer. What is open interest? Open interest are number of contracts. Now, I am the buyer, there is a seller. We entered into a contract. We started a trade. That is trade one. A new buyer came, new seller came. So you have two contracts running parallelly. So your open interest is 2 and your volume is also 2. Now what happened? A new buyer came and this buyer took opposite position as a seller. He went down, so B1 went and new buyer B3 came. Here the volume has increased to 3, but the number of contract remained 2 itself. And therefore open interest remained as 2 itself. And that's offsetting trade and open interests. Okay. So basically, when you are in contract, you have buyer and seller. So when you have one buyer and one seller, that is one contract. We call it as open interest, one, volume also as one. Now, when there is a new buyer and new seller and new contract comes into picture, your open interest also goes to 2 and your volumes also goes to 2. But what happens when a new buyer comes and some of the buyer who were already in the contract, they swap their position by taking counter position where buyer sells and new buyers come in. Such position where one buyer gets swaps by another buyer, that is called offsetting trades. When there is an offsetting trade, your just volume increases, your open interest does not increase.
Here,
And
volume increases due to number of buyer is
here volume increases because a new buyer came into picture and he
but
took a trade. But
so
number
first
of
buyer,
contracts will remain same. Yeah.
so first buyer and seller, that is one contract, one volume, and open interest one.
Yes.
Second buyer and seller, that is two open interest, volume two.
Volume 2.
Now,
Yes.
now
Hmm.
one buyer
Hmm.
is now offsetting by the another buyer.
Yes.
So that's why volume is 3, but the open interest is 2.
Perfect. You are absolutely correct. So that's how volume and open interest differ in option contract. And you need to keep a track of both of them so that you understand how many open positions are going on, and how many people change their positions.
So here,
Yeah.
here volume can be 4 also.
Yeah, volume can be 100 also.
Oh, okay. So buyer offsetting to another means the volume is increasing or changing.
Yeah, even seller offsetting to another can be.
Others. Yes, yes,
Yes, can again be a volume.
yes. Understood.
These people remaining as it is, they are not changing their position, and new buyer and new seller coming together.
Hmm.
That will increase your open interest.
Yes.
Okay. Then you have position and exercise limits. Okay. Maximum number of option a trader can hold in one stock. So I can take, let's say, 100 option, 1000 option, 10,000 option. No, there is a limit. How many options you can trade, how many options you can hold. That is position limit per day. And exercise limit means number of options that can be exercised over 5 business days. How many options you can trade in 5 business days, that is exercise limit. And these limits are there to discourage the market manipulation. Otherwise, one person will try to manipulate the market. That is position and exercise limit. Then you have commission cost. In order to trade in option, your broker will ask for commission, and they can be really high. So if it is a discount broker in India, it charges you 20 rupees. If it is full service broker, it will charge you 300 rupees. Now, in US, you have a fixed amount as and a percentage of trade amount also. That is not the case here in India. You just have a fixed amount. Importance: high commission cost can significantly erode your profits. Let's see from the example. Okay. What does the example says? The strike price is 260. The current price of the stock is 245. We are, because in our formula, nowhere the current price comes under in picture. Assuming the option price is 10, this is the call option. Option price is 10, so small c is 10. And the contract is settled with share rather than cash. Using the commission schedule for discount broker, calculate the commission cost incurred by investor based on initial trade and the investor net profit if the stock price increases to 280. So ST is 280. Assuming the cost to exercise option is 1% of the trade amount and the cost to sell stock is also 1% of the trade amount. Great. Okay. So first of all, we need to calculate trade amount. If the trade amount is less than or equal to 3,000, then you have 30% commission plus 0.8% of trade amount. So let us calculate trade amount. Trade amount is nothing but contract cost. We know it's Chicago board, so lot size will always be 100. Lot size will always be 100. And the option cost is 10. So 100 into 10, your trade amount came out to be 1,000. Now, in this complete table, if it is less than 3,000, you are supposed to pay this much. So let us come up with a commission cost. How much commission I am supposed to pay? $30 will be there. So $30 will always be there. Plus 0.8% of trade amount. that is 0.8% into 1000. So your commission cost comes out to be 38. But other details are given here. Maximum charges per contract cannot go above $35. So your charges are going to 38. So you need to reduce it to 35. Why? Because there's a maximum limit to it. So now the first answer is done. The commission cost incurred by investor on the initial trade. On initial trade, I incurred $35 as a cost. Let us calculate the second thing, investor's net profit. If it's a call option. Sorry. Guys, you there?
Yes.
Yes.
Perfect. Okay. Let's calculate the net profit. How do we calculate net profit? Okay. So look. Intrinsic value is nothing but max of 0, comma, st minus x. This is intrinsic value. Now, but we pay premium, so we will subtract. We also pay commission, so we subtract commission from it. Commission. Okay. Now, let us see. 280 minus 260. 280 minus 260 multiplied by 100. Why? Because 100 is the lot size. This is this value. So 20 into 100, which comes out to be 2000. Okay. Now this value came out to be 2000. How much is the premium which I have paid? Premium is 10 rupees. So minus 10 into 100. That's the premium which I have paid. How much is the commission? Now, commission is, we know, 35 rupees. But we are settling it with the shares. When we are settling it with the share, we need to first purchase the share and then sell the share. So it's not cash settled. So it's with the shares. Now, cost to sell stock is 1% and cost to exercise the option is also 1%. So we are basically 2%. 2% of what? This 1000 rupees. Now, let us look how we came up to 2% commission. Now, look. Our total commission is $35, which we have already seen. $35, which we have already seen. Let me put it in flight mode. Yeah. Plus the share price is 280, right? 280 multiplied by 2%. So 280 multiplied by 100 into 2%. This is the best way of looking towards it. Why 100? Because 100 is a lot size. 280 is the share price at which we are going to purchase, and 280 is the exercise price also. So 280 multiplied by 100 That is the lot size, and 2%. Why 2%? 1% is for exercising the option and 1% is to sell, which comes out to be 2%. That is 560. 280 multiplied by 2 is 580. 560, sorry. So 35 plus 560, I will subtract 35 and I will subtract 560 also. When I subtract all these things from here, I will get 2000 minus 1000, that is 1460, 430, 40 and 35. So I will get 400 and I will get 405. Okay, guys. Please tell me, have you understood this, what I have done here? If not, I can repeat it in detail.
Yes, 280 is the strike price
Yeah.
and 100 is the
No,
lot
not
size.
strike price. Not strike price. 280 is the current market price. Don't confuse it with strike price.
280 is the current market price
Hmm.
and 100 is the lot size,
Hmm.
and 2% is assuming that the cost exercise option is 1% of trade amount and the stock also 1% of the trader
Yes.
sales stock.
So,
So that is
yeah.
2%.
Perfect. 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 Great. Let's move ahead there. Okay. Yeah. Advanced aspects of option trading. In option trading, you need to maintain the margin. You need to check for option commission costs. And if the cost of commissions are high, you go for cash settled, or you basically offset the transaction. If the offsetting transaction just cost you $35, why pay $595? You just offset it one day before. That's it. In option trading, you have option clearing corporations. Basically, these are the people who look who is in profit, from where you need to take money and from where you need to give money. Understanding this factor is crucial for decision making. Yes. Hidden costs. Sometimes it so happen that there is a difference between bid and ask. Offer price means ask price. So if there is no liquidity, someone can sell option at 100 and someone is ready to buy option at 105. So this difference between 100 and 100 and 100 and 105, that is called bid ask spread. We already done this. And the difference in bid ask spread, if it is high, that is again a cost to us, and that is an hidden cost. And you need to calculate that hidden cost also. When there is difference between bid and ask spread, lot of difference between bid and ask spread. Margin requirement, yes, you know that. Basically, if you are in long position, you do not require margin, because your maximum loss is equal to the premium. But if you are in short position, you are required to keep the margin. Chicago Board Option Exchange. Option with maturity of 9 months or fewer cannot be purchased on margin. But options with more than that can be purchased on 25% margin. It's written here. Yeah. Minimum of 25% option values can be borrowed because options are already highly levered product. And again, allowing it to purchase in on margin. What is purchasing on margin? I want to purchase an option of 100 rupees. But I can do it just by keeping 10 rupees as margin. That is leverage. And allowing leverage in option can be dangerous, specifically if you are in short position. Writing options, that is selling option, is very dangerous and margin account is required due to high potential of losses. How do you calculate the margin? Every exchange has its own idea of calculating the margin. So, if high volatility is there, margin will be higher. If low volatility is there, margin will be lower. Yes, uncovered versus covered calls. Okay. Now, if I just take a short position, short call, I can make very large loss very quickly. So if you do not have any other call option wherein after a specific point you are making profit, then that is called uncovered or naked call. And that can be really dangerous. And if you are uncovered, then it requires high margin. If you have covered call, then you'll require less margin, basically. Option Clearing Corporation is nothing but a government entity which makes sure that performance and record of positions are done. If there is a default, then they will take care of it. They do clearing. They have their own capital requirements and they have their finance in case of emergencies. If you are a clearing members, you must be a part of all trades. If you are a non-member, so basically OCC must contract a clearing member to clear their trades. So OCC have their own brokers as a clearing members. And they clear the trade, basically. Exercising an option. Exercising an option means after 3 months, completing the option. Exercise can be done in cash settled or physical delivery also. But when you do physical, sorry, when you do physical delivery, you have to pay extra cost like GST and other things. So exercise an option can be cash settled and physically delivered. Must buy and sell underlying asset at a strike price, and cash settled will happen at your exercise price or strike price. Yes, last 5 minutes, guys, please. This is important. There are other securities which are like options. They are called warrants. What are warrants? Warrants are nothing but options to purchase new shares after 1 year. These are called warrants. Now you have an option. Do you have option today? No. So today's share price is 100. After 1 year, it is assumed that share price, after 1 year, it is assumed that, yeah, after 1 year, it is assumed that share price will be 150. So you will have an option to purchase shares at 75. But this is only given to bondholders. For employees, ESOPs are given. Employee stock options plan. Again, they are same as warrants. Employee stock options, ESOPs. I'm not going to spend time on it. You have convertible bonds, the bonds which can be converted into equity shares. Basically, you have an option to convert it into equity shares. Those are called convertible bonds. Great. That's it from my side.